Welcome to the deep dive. Today, we're tackling a topic that seems to resonate with a lot of you, the learner. It's about making that shift, from being a new trader to maybe eventually a rich trader in the stock market.
Right.
We've got some really interesting source material here, mostly centered around the book New Trader, Rich Trader by Stephen Hawley Burns, plus some related stuff.
Yeah, it's a good one.
So, our mission really is to dig into the key ideas. We're talking mindset, risk, trade methods.
And pull out things that are actually actionable. That's the goal.
Exactly.
And this book, it uses a neat narrative comparing a newbie trader with like an experienced mentor figure.
Yeah, the contrast is helpful.
Definitely. Especially for you, wanting to learn quickly but properly, it kind of illustrates the principles through a story you can follow, makes those aha moments click, hopefully without being too overwhelming.
Okay, so let's jump into mindset first. Expectations. That seems like a huge one right off the bat.
Oh, totally. The new trader mindset often involves, well, frankly, unrealistic goals.
Like what? Like thinking you can double your money fast.
Yeah, exactly. Like turning, say, $10,000 into $40,000 in just 1 year. It happens, sure, but it's not the norm.
So what's the rich trader view on that? More grounded.
Much more. They see good, solid annual returns as maybe, 10 to 25%. 50%, that's exceptional, rare air.
Right, it's about the long game.
Precisely. Chasing those massive quick gains often leads to taking way too much risk. And, funnily enough, getting a big win early on can actually be dangerous.
How so? Because it makes you overconfident.
Exactly. You get reckless. The focus should really be on consistent, steady returns. Getting rich slowly, as they say.
Okay, that makes sense. What about stress? Trading seems inherently stressful.
It definitely can be. For new traders, a lot of that stress comes from, well, the unknown, or from emotions like fear and greed running wild.
And maybe trading too big, putting too much on one trade.
That's a huge factor, yeah. Trading too large a position size magnifies everything. Rich traders, they manage stress differently. They plan.
Plan how?
They have clear entry strategies, clear exit strategies. They know where their stop loss is going before they even enter the trade.
So, in order to sell automatically if things go south.
Right. And they control their position size carefully. All this planning, plus having faith in a system they've actually tested, it helps manage those emotions.
You mentioned emotions. Impatience seems tied into that too. The need to always be trading.
Yes, that's classic new trader behavior. Jumping in and out based on, I don't know, a hunch, or just because they're bored.
Whereas the rich trader,
Waits patiently for the right signal from their system, not trading based on opinion or for kicks. It comes back to that predefined plan. Rules for entry, exit, risk. Like that common rule of risking only, say, 1 or 2% of your capital per trade.
it sounds like learning never really stops then. It's not like you just figure it out once.
Not at all, no. Rich traders are lifelong learners. The market changes. They're always studying, testing, keeping a trading journal.
A journal to track trades.
Trades, yes, but also their own psychology. What were they thinking? Feeling. It helps spot patterns in their own behavior, good and bad.
Let's shift gears a bit to risk management. You touched on it, but it sounds fundamental.
It's the most fundamental thing, number one priority. New traders sometimes treat it like gambling. Rich traders approach it like a business owner. Process over profits, especially short-term profits.
And controlling trade size is part of that business approach.
Absolutely crucial. Avoiding the bet the farm mentality and understanding the specific risks of what you're trading, like that options example in the book.
Right, where the new trader nearly bought calls without even knowing the break-even point.
Exactly. That's gambling, not trading.
Hmm.
Rich traders think about all kinds of risk. Trade risk, sure, but also overall market risk, volatility, overnight gaps, liquidity,
Hmm.
margin calls, even stuff like earnings announcements or political events.
Wow, okay. Lots to consider.
Yeah, and that rule never risk more than 1-2% per trade helps contain a lot of that potential damage.
And a big part of risk is, well, admitting you're wrong, right?
Oh, massively important. New traders often want to prove they were right, so they hold on to losers, hoping they'll come back.
Which can lead to bigger losses. I remember the SRS example illustrating that pain.
Definitely. Rich traders, they use stop losses,
Yeah.
and they honor them. Getting out of a bad trade quickly is vital for preserving capital. It's just part of the business cost.
And on the flip side, knowing when to take profit.
Also key, new traders might let winning trades turn into losers because they get greedy and don't have an exit plan for profits either.
So rich traders use things like trailing stops.
Trailing stops, looking at historical price levels where the stock might run into resistance.
Uh-huh.
Yeah, having a plan to lock in gains.
Okay, last area, methodology. What's the core difference there?
Well, first off, perseverance.
Yeah.
Just sticking with it. Most new traders quit, apparently. Rich traders keep learning, keep refining.
And they find a system that works and stick to it, even when it's not winning every trade.
Exactly. They don't jump ship to a new system every time they have a few losing trades, which new traders often do. They understand that even good systems have drawdowns. The system needs to fit them, their personality, their risk tolerance.
And it's based on probabilities, not predicting the future.
Yes. Trading what the market is doing, not what you think it should do. Following price action, volume. Trading with the trend usually helps stack the odds in your favor.
So looking for those sweet spots on charts, breakouts, pullbacks to support.
Right. High probability setups, and typically trading liquid stocks where you can get in and out easily. It's all about playing the probabilities based on a tested method.
Okay, so wrapping this up, it sounds like the real journey from new trader to rich trader involves a big mental shift
Definitely. Away from chasing fast money towards focusing on a consistent process.
and making risk management your absolute top priority, protecting that capital.
Mm-hmm. And having a disciplined method you actually follow based on probability, not hope or fear. And, of course, never stopping learning.
So here's a thought for you, the learner listening in. Reflect on these three pillars: psychology, risk management, and methodology.
Yeah. Which one resonates most with how you approach things right now? Not just investing, but maybe learning anything new or tackling a big project.
Where could applying some of these, rich trader principles like planning, managing downside, sticking to a process make the biggest difference for you? Something to think about.
And if trading itself interests you more deeply now, the source material mentions some other books too. Worth checking out if you want to keep exploring.
Absolutely. That's all we have time for on this deep dive. Thanks for joining us.